Hi folks, welcome to this video that will discuss what we would normally include in a cash balance. Now, some of the things that we already know to include, we talked about in a previous chapter, so I'm going to try and focus right now on some of the things that might be new to you. So one of the things that comes up in this chapter that's new, that needs to be included in cash, are any money market funds that have checking privileges. So you might have gone out and bought some money market funds or know of people who have. These are can be equity investments as well as fixed income investments, but the idea is it's a fund that has checking privileges, and whenever you can write a check on an account, it's going to be considered to be part of cash. So this is one rare instance where we do find if we have money market funds, whether they have just equity investments or a combination of equity and fixed income investments, if the bank allows us to write checks on them, then we consider them to be cash. Some of the items that we've already looked at in our course to date that we considered when we were determining a cash balance were some of these things. Cash equivalent. Cash equivalent is a current asset, but it's not included as part of cash. In fact, the classification is equal to what we call cash equivalent. So that's the account. I should put maybe account. Cash equivalent. And the way we defined the cash equivalent is we said its maturity is within 3 months from its purchase date. We also talked at length about restricted cash. We said it would be part of our cash account in the current assets section if that restricted cash is set up to handle a current liability, like an income tax return. Usually, if we have any cash of any kind that's restricted, we would normally do a note disclosure in the financial statements. If we had cash that's restricted for a long-term purpose, to settle long-term debt, to settle a plant expansion, or to help finance it, if we're setting it aside, it's a non-current asset and specifically a long-term investment. If we had a bank overdraft, we've talked about overdrafts many times, we would include it in our current asset cash balance if we can net it out of the cash, because normally a bank overdraft means that we owe the bank money. So we can net it out of our current asset cash balance if that overdraft account and the account that we have money in are being held at the same bank. But if they're being held at a different bank, then we have to set up the overdraft as a current liability. One item we discussed before, you may not remember, so we'll refresh your memory here, is if a company goes out and buys preferred shares, and those preferred shares are purchased close to maturity. We consider them under IFRS, even though they're equity, to be cash equivalents. Under ASPE, because they're equity, they would consider them to be fair value through net income investments. So this is a little bit of an oddity under IFRS. We normally don't see cash equivalents as shares, but because they're purchased so close to maturity, and we know exactly what we're going to get back because they have a term at which time they mature, and we'll get back our principal, the idea is that they're treated like a cash equivalent. But the idea is usually these preferred shares would be purchased within 3 months of their maturity date. Okay. Now, some new items that come up in this particular segment are things like receivables from employees, we call them IOUs, post-dated checks, and travel advances. How do we handle them? Well, first of all, none of them are cash, but they are odd items that we need to know where they go in the financial statements. If our employees, if we loan them money, then we would set up an account known as, for example, receivables from employees. Sometimes you might see that lumped in with other receivables, but the idea is we've advanced money to our employees and we expect to get it back from them. In fact, we're going to deduct it from their pay by a certain date. But employees owe us money, so it's a receivable. What about post-dated checks? In many cases, post-dated checks are from our customers to pay off an account. Well, if our customers are paying us off and they send us a post-dated check, technically we can't cashed that check yet. So because we can't cash it, we don't apply the cash or the check toward the customer's account. So it still stays in accounts receivable. Travel advances, for example, if our employees are traveling on company business and we advance them some money, we consider that to be prepaid travel. What would normally happen is that when we advance the money to the employee for business travel, they might book their hotel, their flight, their train, whatever they have to do to get to where the meeting is. And once they come back from their trip, they would submit an expense report and they would look at what they spend as opposed to what we advance them. But the idea is because we gave them money in advance, we've prepaid all or part of their travel expense. So that prepaid travel would be a current asset, but notice none of these are cash, but they are introduced in the chapter, so I thought we should discuss them. Now, when we do the next exercise in this video section, in this little lecture series, the next problem is doing an example for you that might include some of these accounts and might include some of these things up here. So you might want to try the problem that follows this video to see if you can do it and apply some of these concepts. I hope you found the video helpful.